So we're going to cover today, start out with the foundation of options. We're going to go through the Greeks and go through how important they are and what they do as far as helping you measure statistically price differences and things that shape and change price for an option and how they impact the option. So we're going to look at delta, gamma, theta, vega, and implied volatility, and then go through the pricing the option, how that works, the market maker secret. Big part of option trading and trading in general, it's about probabilities, so standard deviation and measuring probabilities. So we'll spend a good chunk of time on that so you'll understand exactly how that works and how you can use it to help you forecast price targets and direction based on targets that are viable targets based on standard deviation. We'll look at option delta and how to use that in your trading for trade probabilities. And then we'll go through kind of go-to option strategies, the strategy guide that some of my favorite strategies that are really quick strategies to jump into that have great risk parameters and return on capital. So we'll look at that, go through those strategies, trade examples. Then you'll have a resources with assignment risk, standard deviation, and a trading library. So the following course, webinar Q&A, course today is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So, the goal of every trader really should be to select those trades that are based on providing you consistent positive equity curve. So for me, I like a kind of a smooth equity curve, not a whole lot of volatility, a lot of ups and downs. So I'm pretty, very defined risk as far as what I'm looking at, good risk parameters, risk control. And the best way to achieve this is through the use of options and option spreads. So we're going to start off first, though, with going through the Greeks, the importance of the Greeks and how they affect the price of the option. So we'll look at theta, delta, gamma, vega, and the implied volatility. So when you're using the Greeks, you're trading, you're trying to predict what will happen on, to the price of an option as the markets change. So it can be a very difficult undertaking because option prices do not always appear to move in conjunction with the price of the underlying asset that you're trading. So it's important to understand what factors contribute to the movement in price of an option and how they affect that price. So that's where the Greeks come in handy. And so the Greeks provide a way to measure the sensitivity of an option's price to quantifiable factors. So these terms may seem confusing, intimidating, but when you break it down, the Greeks refer to simple concepts that you're going to see that can help you to better understand the risk and potential reward of an option position. So the Greeks, they're strictly theoretical, so that means that the values are projected based on mathematical models, and all of the best commercial option analytics packages will have this for you. So your brokerage sites, the good ones, the option sites, should have really good analytics for the Greeks. And I like to use Thinkorswim, and that's what we'll be using today. And it's a free platform, but it's got really great option analytics. So if you don't have a good platform, if you can get your hands on Thinkorswim, it's a good one. And again, it is free. So you just go to TD Ameritrade, open an account, which you don't have to fund. It takes all of 10 or 15 minutes. And then you can upload the Thinkorswim platform. So you'll see me using that here today. So first off, let's take just kind of the review of the Greeks. So you've got theta, and that's for decay movement. So this measures the time of decay of an option and on a per day basis. So this is going to increase each and every day as your option or your underlying security that you're trading gets closer to its expiration. And then we'll go through delta, which is a measurement of price movement. Measures the price change of an option per a dollar change in the underlying. Implied volatility, it's also price movement, so what the marketplace is implying the volatility of the stock will be in the future. And then gamma, so that's also price movement. and it's the rate of acceleration of the delta. So you're going to see that it's most at risk and largest in the week of expiration and the day of expiration. And then Vega also for price movement. This measures the price change of an option per a 1% change in the volatility, and this will also decrease each day and goes to 0.